Good afternoon, everybody. This is Matt, aka the Lumberjack Landlord, here with Mike Zuber, one rental at a time. Mike, how's it going?
Good, man. This is an important concept. A lot of people are not going to get it in the first couple of seconds, so keep at it. Realize I have a very strong opinion about this one. So give this a few minutes, see if it makes sense to you, because I promise you it should. And if it doesn't, you need to watch it again because it's awesome.
Before you throw your phone and say Mike's an idiot,
Yeah.
give it a couple minutes. Because when he first did it, I was like, what? And then he said it again. I was like, all right, I think I know where you're going with this. So let's get into it. So Mike, talk to us about the concept of why investors like 8% money.
Yeah. So just to be very, very clear, if you're a real estate investor, right, if you're in the course, how to get started one rental at a time, there's no question that your largest monthly expense is your mortgage payment. Mm-hmm. And the largest variable in your mortgage payment is interest rates. I understand that. I know how math works. But let me just tell you, I think we should all be excited for 8% 30-year money. Frankly, I would be excited for 10 or 12%. Now, some of you are already throwing your phone down. Let me explain. If you're in my course, we only do positive cash flow deals. Not only is that a fact, but we only do great deals. All of you have done the work for 60 or 90 days and now could intelligently tell me that 6, 8, 10, 12% is average in your market. Let's take Dion from Dion Talks. Excellent example from Three Amigos on Thursday. He has been looking for a fourplex for over a year. It has been a wacky market with no inventory. Interest rates have been in the 3s for investors. Anybody can really do a deal in that environment. It's very easy. But interest rates are going up. In Dion's spreadsheet, he has changed the variable to 4.8%. So a fourplex comes on the market Saturday. He's like 1.4. He's like, oh, that'll be gone in 24 hours. Looks at it Sunday, still there, no offers. Looks at it again on Monday, still there. He knows his numbers. He wrote an offer at $1.1 million. Why? Because his cost of capital is not 3.2, it's 4.8. Right. And he knows and expects and only does great deals. And his market's 10%. So here's the deal. He may not get it, but again, there'll be another one. So why do I say investors should love 8%? Again, all Dion would do is he would change the mortgage calculation from 4.8 in this example to 8. And instead of offering 1.1, he would have to offer, I'm going to make it up, 875, 850, 8.25. If you are following one rental at a time, you only write great offers. And as the cost of capital goes up, your numbers will tell you what to write. Here's a hint. You don't have to write list price. I know we've been spoiled the last couple of years and you think you have to pay over and waive conditions. That's not most markets. Right. It's going to be okay. So again, why do I like 8%? And 8% is just an example because it's meant to shake you. I don't think they're going there. But again, think about it. Who is your largest competitor? Well, if you're following my model, it's owner occupants. 67, 68% of units are owned by owner occupants. Who gets scared at 8% money? Owner occupants. They are like, oh my God, the world is falling. Well, if I can't get 2%, I'm not doing it. Bob, I mean, all these things happen. People are human beings and they're predictable. If interest rates run to 8%, you are going to see a lot less offers, which means you are going to be able to find motivated sellers. Now let's go back to Dion's example. He's waiting to see in the next couple of days if it gets accepted. I think he put a clock on it for this Friday, so we should know soon. One answer is going to be the owner's not motivated. So they're going to decline 1.1. They may counter at 135 or something, which Dion won't do because his top end, he knows his math is 111. So that listing will age out and the owner will take it off. That is perfectly acceptable. And that is going to happen left, right, and center going forward. That's why prices aren't going to crash because a lot of owners aren't going to drop price. They're going to be like, oh, I like my fourplex, I'm good. Or my house or whatever. Second, a lot of owners are not going to sell. If interest rates go to 8%, the move-up market is dead. Dead. Yeah. Right? Because they're going to stay on their 3% mortgage. Mm-hmm. Thus, anything that goes on is going to be probably a motivated seller. So what I tell folks is the cost of capital is one variable. We are heading into the real estate slowdown that I called point blank last Wednesday, and it is happening right in front of us. Pending home sales reported this morning on the daily financial news down 4.1%. Why? Because just in a month, the mortgage payment is up 8%. Simply because the cost of capital. We are going to have less people qualified, less people writing offers. Inventory is going to build. Days on market is going to be awesome. And again, 10-year mortgage is up at 2.5 or almost 2.5 this morning. It is the real estate slowdown is happening. I am so excited. I hope 30-year money goes to 8% because I only write great offers and I'm not afraid to write offers below asking. I've been doing it a long time. It's a habit. I have a scab. It doesn't bother me whatsoever. I do my numbers. People that are in that course, how to get started one rental at a time, you should be ecstatic at 8% 30-year money because we will write great offers. And then guess what happens? You write an 8% offer, 30-year money today, 4, 5, 6 years from now, we have a nasty recession. Guess what happens? The Federal Reserve's wax interest rates and we go back to 5%. I'm not even saying we go back to 3%. Let's just say we go back to 5% in 5 years. What do you do if you're a one rental at a time fan? You refi and recycle capital. You take out your down payment and your mortgage payment doesn't change and you have all this cash flow and you buy your next thing. You will get to repeat the cycle that I've done over and over and over again. If you are an investor, it is time to hunt. It is time to eat. Cost of capital doesn't matter. Just change your variables. It's time to hunt, time to eat.
Definitely. Couldn't agree more. I actually had a post on one of the videos that we had done. They said, so let me get this right. I should just pay $100,000 over ask, $200,000 over ask, even if it's 18% interest rates, I should just keep on buying. And my answer was, yeah, I don't know what video you watched, but I definitely never said that. Here's what I can tell you. Here's what I can tell you, Mike, let's just get nutty.
Sure.
Let's say we revisit the early 80s.
Okay.
And we see mortgage rates at 14%.
Okay.
I'm still a buyer.
I will buy every great deal at 14%.
Right? Because that's
we only buy great deals. Cost of capital is one variable.
It's all that matters. When we look at this and we say, whether it's a 7%, a 3%, a 12%, a 22%, if I have a 22% mortgage and that makes my mortgage payment with taxes and insurance $4,000 a month, but the building pays me $6,000 a month, I don't care what the percentage is so long as it's one thing, 30-year fixed rate debt that's locked in, because then my payment is not going to go higher.
Here's the deal. I would be ecstatic with every great deal I did at 22% because I'm a student of history.
That's right.
And I know they would not stay there.
Right.
And what do I do at 11 or 15 or 9% interest? I refi. My cash flow explodes. I maybe even refi and take cash out and go buy again. Dude, the higher the rates are, the better our future gets, because
that's right.
Watch the Fed. I mean, rates go up, rates come down. It's, again, man, it just came to me this morning. It's time to hunt, time to eat.
Yeah, it absolutely is. Like I said, I think, listen, if you're watching this video and you're not part of the course, so this isn't for the people that are in the course. They know this stuff, right? Mm-hmm. But this is for people that aren't in the course. This is exactly the framework that gets taught in one rental at a time. This is the framework. This is how all of us real estate investors have become wealthy over time, is we've looked at it, and regardless of rate, we don't care about rate. The only thing we care about is, if I put $100 in, how much do I get back on my $100?
Yep.
Whatever the percentage rate is. And quite frankly, here's the thing that kills me, Mike. If I had the chance to have done in 09, when I got a loan quote that was 10, or in 08, beginning of 09, it was 10.25%. If I had a chance to do that deal again, I would so do it.
Yeah.
I would so do it. I got freaked at that time. I got freaked out by the 10.25. And I was like, 10.25, that number's insane.
Yeah.
But the numbers actually still worked on the deal. I should have done the deal and then refied at 3.
Yeah, exactly.
Holy cow. Like
Yeah.
that one property, I mean, didn't triple in value, but probably over doubled in value.
And your
Almost-
cash flow explodes. I
and
mean,
cash flow off the
yeah.
charts, right?
Now this is why being an investor with high rates is great, because it's a very different conversation if you're an owner occupied, right? Because you don't have cash, the building's not producing anything, right?
That's right.
So yeah. Yeah. If the 30-year money went to 8%, because again, I think rates go up, although they're going up much faster than I anticipated. If they continue to go up this fast, dude, second half of this year, it's going to be a lot of fun.
I mean, yeah, man, right? And then here's the thing. It can be a lot of fun.
Yeah.
But people are going to have to get over the mindset. This cripples people. It crippled me for about 3 months in 09.
Yeah.
When I was looking at it and going, oh my word, 10% mortgage, I'm never going to be able to do a deal again. And then you start seeing the foreclosures stack. Exactly. And then you start seeing, okay, now the market's starting to normalize a little bit. We've saved the market from a meltdown. Exactly. Now things are starting to normalize. Now you can actually start, now the banks are lending again. Now you can start to see rates. And man, Mike, there in that market, there were 50, right now there are 5 buildings in my buy box. It was running between 40 and 60, and half of those were foreclosures.
Yeah. And
anybody that bought any of those deals doubled their money. At least doubled their money.
Oh, I mean, if they're down, it's again, I want to say it one more time for the people in the back of the room. As a real estate investor who's doing how to get started one rental at a time, cost of capital is a variable. It doesn't matter. You are only going to do great deals. And if you can do a great deal at 8 or 10% cost of capital, you are set up to repeat what I did, because you're going to do the great deal today. It'll be a great deal tomorrow. And then in 5 years, when rates get whacked, you're going to really like the deal. So,
I mean, yeah, like because we lived through that, right?
Oh, a couple of times.
Yeah. Way up here we bought, and then, sliding down. And then it's like, okay, margins are tight, 6-8% returns. Those are the deals now after refi that are making 20, 22, 25, 30, 35% on money. And that was, again, it's the rate game. It's cyclical. Might it be 5 years, maybe 7 years, maybe 10 years, maybe
it's coming. That's all that matters. It's coming.
So far in the history of time, it's always happened.
Yeah.
So far.
This
time could be different. And then in that case, we all have much bigger problems.
There you go. Yeah.
So Mike, tell everybody go ahead.
I'm again, people hear me say 8% money and they shut off. If you're a real estate investor, it's not that you wish for it, but the faster and the higher it goes, the more excited you should get. Your biggest competitor falls away.
Yeah. 100%. Well, that's not even falls, runs.
Yeah, exactly. So yeah, if you want to follow me, one rental at a time is my shtick. Website, books, courses, Instagram. Have some fun. So it's been a lot of fun conversations.
Absolutely. Where can they find you, my friend?
One rental at a time.
Books, 6,000 videos.
Yeah. 5 million views. I just got a note from YouTube this morning. 5 million. That's what it said.
So I think we've done 500 videos, Mike.
You and I
think we've done almost 500 videos.
Yeah. You have the largest playlist on my channel.
Not most watched.
Not yet.
Mike, thanks so much for your time. Guys, as we always do, we put together great content for you. Subscribe, hit the like button, forward this on to folks. Make sure you attend the live stream with Mike from One Rental at a Time on Saturday, 11 a.m. Eastern time, 8 p.m. Pacific. I'm on 11:30 a.m. Eastern time on Sundays, also on Instagram, Lumberjack Landlord. You can check Mike out at One Rental at a Time. And then our buddy Dion from Dion Talk Financial Freedom, Tuesdays, 4 o'clock Pacific time, 7 o'clock Eastern time. He goes until the questions end. And last week, I admit it, I stacked him with 6 questions just because I wanted to.
Is he going to keep going?
It was like 3 hours and like 4 minutes. And I was like, I have some questions and input I'd like to get. It was good. So guys, thanks so much for supporting all of our channels. We're super excited for the times that are to come. Don't be afraid. Know your numbers, do the math, be prepared, dry powder, understand exactly what you're doing. And this could be the greatest buying opportunity that you have ever seen. This is how good this could be. Mike, thanks again for the time. Guys, have a great week, and we'll make sure to have some fun on the live streams tomorrow. Thanks again, Mike.
You got it.